Today we're talking all things UK because the UK has released a ton of data this morning at 7 a.m. So we're going to be focusing on UK GDP. And then the second topic is going to be whether a UK house price crash is actually in store after seeing Taylor Wimpey, the big house builders, earnings earlier this week. And the trading takeout today is going to be a bit of a funny one. It's going to be how to actually cope with winning trades rather than losing trades. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So the UK GDP data has come in and we've averted recession, which many were predicting we actually wouldn't. Because the expected number was negative 0.1% and the actual was 0%. Now, this is in fact better than our European counterparts. Of course, Germany is in currently quarterly recessionary conditions, and it doesn't look like they're going to finish the year with any kind of let up there. It looks like Germany will be in recession again at the end of this year. So the net benefit here, however, is actually the year-on-year number, which came in at 1.3% with expectations of 1%. Now, in my view, over the longer term, this is really still what's mattering. We haven't seen a broader degradation on a number of metrics just yet. For example, we haven't seen unemployment in the UK tick up broadly, which probably results in still some resilience, which doesn't mean we're quite in the recessionary camp just yet. Now, the pound, well, the last time I had a look at the pound, which was about 10 minutes ago, is currently a tad stronger off of the back of this data that we received at 7. It looks like it should, have a fairly decent day here, in my view. It looks like we should be able to maintain some sort of rally up to maybe the 1.22 and a half level, which is about 30 ticks away currently, which is quite good on an intraday basis for FX, returning back to the place at which it sold off just there. Now, going forward, I would expect most of this to be influenced again by the dollar. The dollar's been actually relatively weak recently. If we have a look at Euro USD, we can see that the euro is getting stronger again as well. So the dollar's been facing some significant sell-off, and this is primarily to do with bond yields. So you can see that bond yields have been collapsing through November. It probably doesn't mean that we are going to see a broader-based collapse here. I think it's just sort of a bit of bond buy-in. I don't think it's a broader rally just yet. But it does show that there's been a slight change in regime, a slight change in interest rate pricing, which means that we're probably at the peak of interest rates. So bearing that in mind, you can cross that into how FX is moving, maybe a little bit of a weaker dollar for the next couple of weeks, but I think into year end it will strengthen up again. The UK housing market isn't doomed after all, as big builder Taylor Wimpey came out with a profit target, a forecasted profit target of the high end of their forecast for the end of 2023. They are predicting that it would be between 440 to 470 million pounds. Now, at first glance, this does indeed sound exactly like, the UK property market is going to be fine. However, one of the key indicators here of their guidance was that they're actually cutting costs and they're optimizing across the business, which doesn't necessarily mean that demand is there. It just means that they're able to cut back. And you have to remember that share prices only care about relativity. It only cares about how well something's doing forecasted versus where it is now or, in the past. For example, Airbnb has rallied 40% this year. Why? I mean, it's purely only because it was shut down shut down during the pandemic, and now things have reopened. So anything is going to be better, even though the property sector is not doing that well. So you've got to realize that all markets is a view on what things are now versus what they are forecasted or expected to be, and how volatile that is. That is all we're looking at when we're looking at markets. And so when people say, oh, yeah, you shouldn't predict stuff, well, you should. All markets are is a gamble at the end of the day. And so it's important to recognize this. And this is really why, even though the expected number isn't a blowout, and you can actually see that from what their previous year was. So their previous year was 923.4 million. And then obviously now it is 470 million guidance. So it's not even hit that yet. So you can see that there's almost like a 50% decline there in profit for this year, but it's better than expected, if that makes sense. So we can see that the share price rallied initially. This was just yesterday. Here was the rally on open. And then now you can see that it's trading down a little bit as well. I think this is exactly what the market is sort of pricing now. It's pricing that, you know, it's just a sort of technical or base effect type thing. It's not, you know, reality. So at first glance, it looks like the UK property sector is fantastic because house builders aren't getting completely smashed, but it's only because these Persimmon is the same, another UK house builder. It's only because Taylor Wimpey and Persimmon are doing slightly better than expected. That is all it is. But the lesson here is really how markets move and what makes markets move. It's expectations versus reality. Kind of like Instagram, I guess. Now, there's so much talk of how to deal with losses in trading that dealing with wins kind of gets, I guess, brushed to the side. You know, everyone's more emotional about losing than they are about winning. But the problem with winning can actually be worse than the problem with losing. See, a lot of people might start attributing a couple of wins in a row as being down to their skill. And when that happens, their biases seep in, and effectively it can create bad habits. For example, if you've been on a couple of winners, you might expect then that you are in fact on a winning streak, and you might attribute that winning streak to something that it is not. This can then cause you to maybe over leverage or, you know, to do the wrong thing. It doesn't matter what it is, but unless you are adequately trying to understand why you're winning, winning can actually be worse than losing. Because something that you might notice or might hear about is loads of people who during the bull market of 2020, 2021, they made a ton of money, but they attributed this to their skill rather than simply the market conditions. When the market conditions changed ever so slightly, they tried to replicate, you know, the exact same thing as during the bull market, and then they lost 70, 80% of their funds. So understanding exactly why you're winning is probably more important than understanding why you're losing. And of course, you can attribute quite a lot of it to luck, but being able to really nail down the difference between luck and alpha, so alpha is, you know, how much you beat a benchmark by, is really, really important. Once you understand that, you take those conditions that you succeed in and try and only trade in those conditions. That is probably the best piece of advice that I can give you when it comes to dealing with winning.